Hello and welcome to the channel. If you're new here, thanks for joining us, and if you've been here before, thanks for coming back. In this video, we pick back up where we left off in our last case study. At that time, we formed a new hypothesis, and now we test it here.
So we're back in our Sierra chart platform. We have our ADX Momentum loaded from a prior case study. So what we're going to do, we're going to use the exact same settings. So if you recall, if you watched a prior case study, these are the results that we got back from applying this system in its current settings on the E-Mini S&P 500 futures. There's a lot of room for improvement, just from monitoring the back test periodically. Some things that were readily apparent is that the system was attempting to take trades and during periods where it was not likely to have continuation. But one hypothesis that led to me forming is that what's the likelihood that simply changing the instrument would actually improve the results? Because we know different instruments have different market microstructures. So the dramatic shift that happens from one session to the next in the E-Mini S&P 500 is not necessarily the same magnitude for some other instrument. And then this particular system was taking overnight risk. So we were holding trades and taking trades at any point in time during the any trading session. So as long as the instrument was trading, our system had the ability to trade. So what we're going to do in this case study is that we're going to put that hypothesis to test, that hypothesis to the test. So we're going to click on find symbol, and we're going to change our instrument to gold. And we're going to test this hypothesis on gold. And let's see if simply having an understanding of the variation between market microstructures, understanding the assumptions and the limitations of the system could completely change the outcome. So we're gonna cancel these phantom orders. We're going to disconnect from our live data feed, and let's bring back over our control panel. We're going to go back to make sure it's on accurate trading system backtest. This looks good. So we're not changing anything. So to recap, let's look at our parameters. So our ADX length and moving average length is 3. This is on a 15-minute interval. And within our foundation, we're entering after the bar has closed. Our returns look back is the last 20 bars. Our ADX threshold is 30. So essentially the system is trading based off of whether or not returns are positive or negative. And if the ADX is above the threshold that's set, and we have some type of volume imbalance, then the system is taking long or short trades. And then again, if at any point in time you forget what any of this means, you can click description here and it will pull up an entire window in your browser that goes into details about the actual implementation of the system, as well as what all of these different settings are. So we're not changing anything. We're leaving everything as is because we like to make an apples to apples comparison between implementing this system in one instrument versus the other. So we're going to continue to use institutional flow, using our dynamic risk management, machine learning systems. So this looks good. The one thing that we're going to do is currently, so that we can do a side-by-side, currently we are in account sim 12. So we're going to change our account to a different account. So we can attach a trade window here, and we can just go down to maybe sim We'll go down to Sim 13, and then we'll close this window. And now we're trading in Sim 13. So we want to make sure we don't overwrite the results from our last test, so that we can do our apples to apples comparison. So now we have Sim 13 here, and we're going to start our back test to clear out those prior results from Sim 13. And we can bring back over our trade activity log. Once this QC or query counter drops to 0, we clear out these past results from a prior back test. We can start this back test specifically in gold, and then we can analyze and compare the results. So we may have to, let's restart this. We're going to clear this out and refresh this. Okay, to move things right along, I just switched our account to Sim 11. We can see here in the upper left, we're now in Sim 11, and we have this Sim 11 trade statistics cleared out. So we can start our back test. Let's move our window and let's play. So we see we're reading in market data. Our machine learning models are making forecasts for volatility and liquidity, which is powering our dynamic risk management, our institutional flow, as well as our volatility filtering systems. So what I'm going to do is allow this to trade over our period. And then once the back test completes, we'll come back and we'll analyze the results and then do a side-by-side between the prior test on the E-Mini S&P 500 and this particular test to figure out, the effects of just changing or applying a system to different market microstructures, just to test my initial hypothesis based on the observations from our test on the E-Mini S&P 500. Okay, so our test just completed, and let's bring back over our trade activity log. Okay, so to recap, in a prior case study, we ran this exact same system, exact same settings. The only thing that we changed in this case study is that we switched from the E-Mini S&P 500 over to gold. And then from observation of how the system was performing in different sessions, the transition, the change in the market microstructure that I witnessed in the E-Mini S&P 500, and then also being aware of the assumptions and the limitations of both the strategy and how those particular settings affect those assumptions and limitations, I formed a hypothesis in which, in the last case study, my hypothesis was that I believe if we did not change anything, if we only changed the instrument, just understanding the difference between the market microstructure of gold versus the market microstructure of the S&P 500, understanding the assumptions and limitations of the system, of which we included institutional flow and dynamic risk management. We didn't include our volatility filtering in this, but we did include our other machine learning systems. Understanding the taking that holistic view and understanding how everything interacted with each other, I formed the hypothesis that this system would likely perform better on gold given those settings. And then we can see here that's exactly what happened. So this actually validated my hypothesis, because if we look at these settings or these results, we're actually profitable. So we have a profit factor slightly above 2, significantly more than what we had when we applied this system to the S&P 500 futures. We had a profit factor, I believe, of 0.62. We'll go back and take a look at that account momentarily. But we have a profit factor of 2. We had an equity peak of right at 8,000, equity value of 4,300, meaning that this system was never offside. We were never offside. Max drawdown of roughly 3,400. We paid 120 in commission. We took 15 trades. We're roughly 27% profitable. What else do we see? Our average profit factor is roughly 6. So there's potentially some even further down sampling that we could do. This is our average time in trades of roughly an hour. Winning trades, we're holding significantly longer than the losing trades, which is good. So, and our dynamic risk management system selected a 2-lot as being the most optimal position size. So I think our initial lot size is a 1-lot. We only allowed a max size of a 2-lot, and a 2-lot was what we traded. So if we go back, let's pull up. So I have the display settings open in another window, and I'll just switch from this account to Sim 12, which is the account from our prior case study. Look at the stark contrast. The percent profitable is actually similar. They're both roughly 27% profitable. But look at the frequency of the trades. 91 trades versus 15 trades over the exact same period. A profit factor of 2.09 for gold versus a profit factor of 0.62 for the E-Mini S&P 500. Look at the equity peak here and just versus what we just witnessed when applying the identical system to gold. Right? This is 1.65 average profit factor. Okay. And if we switch back to our current results, stark contrast, very stark contrast. So this really just nails home. Just, you need to understand not only the system that you're using, the assumptions and limitations of the system. You also have to understand the market microstructure. You also have to understand the implications of using certain settings. So again, we use institutional flow. We right click and go back to studies, back into our foundation. We're using our dynamic risk management system and our institutional flow system. Both of these are proprietary machine learning systems that we build, maintain, and develop in-house. So that's what we're using. And we're using the medium flow sensitivity. We're not using our volatility filtering. So another experiment could be, what happens if we actually add volatility filtering? Could we improve the S&P implementation by simply using volatility filtering? Again, another hypothesis of mine is that if we use our volatility filtering machine learning system on the S&P 500, my assumption is that it would probably improve those results. There's some other things that we could also do, just me looking at things from a high level with respect to the trade management. But definitely, I believe if we include volatility filtering for the S&P, that probably would improve our results even there. So this is the process that you're able to go through in a no-code environment, leveraging professionally developed quantitative and machine learning models to fast track your automated trading. All of these systems, all of the foundations, the machine learning models are available in the strategy lab. You can visit our website to learn more about that. We have 2 different tiers. This system or this foundation is actually available in our premium version of our strategy lab, along with other foundations, proprietary research you also gain access to, as well as the machine learning models. So we'll leave it there. This was a really great experiment. Key takeaway is that you also have to really understand the market microstructure and how it plays a role into the assumptions and limitations of your system in addition to the effects of the parameters, the filters, the indicators, whatever tools that you're using to indicate the phenomena that you're trying to exploit. You have to understand holistically how everything works together and over different time periods. Thanks for watching.
To get access to the exact no-code systems featured in this video, so you can begin your own experiments, visit the link in the description to learn more about the Strategy Lab. You'll gain access to the system and machine learning models used. Also, if you would like to learn more about how professionals structure their system development, be sure to sign up for our free course, Automated Trading Foundations. The link is in the bio as well. Don't forget to follow us here and on our other social channels to receive additional insights to fast-track your automated system development.